We're going to take a closer look at these revised GDP numbers and what it tells us about the economy and the markets. Here's Anthony Chan, the former chief economist, JP Morgan Chase. Good to see you again, my friend. These GDP numbers, I guess, not too hot, not too cold. The market didn't really have a big reaction to it. Maybe they're happy with those type of numbers.
Well, relative to Europe, Phil, it's not a bad number. Germany, of course, coming in with very weak GDP numbers. We have a 1.3% number, which is quite strong relative to what they're experiencing. There's no doubt in my mind that in the second half of the year, the economy will slow down. But notice how I say the second half of the year, because in the second quarter, it looks like we're going to have economic growth that's much faster than the first quarter.
So if I just take a step back, Anthony, and look at where we were last year, right? We were coming out of COVID, and I mean we as in, I guess, most of the world. They were coming out of COVID. Everybody was angry and happy and trying to spend money, and so the economies all kind of take off. Then we worry about inflation, and we jack up interest rates to some ridiculous number where we are today to slow the economy down. It's not surprising that the numbers are where they're at. I'll tell you what's surprising is they're not weaker than what they are, given what we've done to the interest rate environment, that the U.S. economy still remains, for the most part, arguably strong, especially when you look at the number of job openings that we have in this country.
Well, but even those job openings have come down over 2.5 million from the peak that we saw. So the economy is slowing. But if you really want to unlock the mystery as to why we're still experiencing positive growth, it's all that spending that took place. And we still have about $500 billion of savings that are in excess of what we would normally see if this was a normal trend. Now, it's not as high as that during the peak of the pandemic when we had an excess of over $2 trillion worth of excess savings, but $500 billion, that explains why, despite the fact that the economy has a tendency to slow down, we are still seeing super strong consumer spending coming in at 3.8% in the first quarter.
Yeah,
there's no doubt in my mind.
Look around us, Anthony. Airplane prices are high. Hotel prices are high. And I know this is part of the travel, but let's just look at regular living expenses. Rents remain high across major metropolitan areas in the country. We have still a disease in this country where we continue to want to spend money, which actually helps the economy in many ways. With the unemployment rate where it is, and the Fed looking at this going, well, we want the economy to slow down, they're raising rates. From their perspective, it could be argued that it's not working with the intended consequences, and they could possibly have to raise rates even further if they're trying to squish and smash inflation.
Yes, Phil, if they're trying to smash inflation over the near term, if they become a little bit more patient, they can afford to pause and say June and then think about it a little bit more. The question is, how urgent is it to lower the inflation rate down? And for all those people out there that say the economy is weak, all one has to point to is the fact that we have the lowest unemployment rate in 54 years. If this is what a weak economy looks like, I don't know how many people could really complain when they look at the numbers real closely. It's not booming, but lowest unemployment rate in 54 years is not a bad number.
The unemployment number, and so I don't want to sidetrack this too much, but I know a lot of people who kind of work part-time or, quite frankly, don't work at all. And they're choosing not to work, just so you know. And they're not looking for a job. They do side gigs. How are they counted in the economy, these part-time workers? Are they part of the unemployed group, or they're not?
No, not at all. If you're working part-time, you're employed. It's just a question of whether you're working 40 hours or 10 hours. The people that are working under the table, those don't get counted because they're not in the labor force, and especially if they now don't report that they're looking for a job. But whether you work 1 hour or you work 2 hours, you're counted as employed.
So, okay, so what now for the Fed? There are some concerns that they could possibly raise rates. According to your scenario, they should pause, which I think that's a very likable scenario given everything that we've been through. Assuming they pause, then you're saying that we would get a rally, potentially, or strength in the economy, which then sets up another problem because now the economy might be too strong and we could see inflation coming back in again. And we're already starting to see, for example, used car prices tick back up.
That's true, but there are other forces at play that are going to weaken the overall economy. And even though I'm saying that the Fed is likely to pause in June, personally, I would love them to continue to pause even through the remaining months of the year and just be a little bit more patient about slowing down inflation because of the risk that you're talking about, Phil, that we can crash the economy. So right now, I would love them to pause, continue that pause. And by the way, let's count the winnings when we have them. The inflation rate peaked at 9.1% on the CPI. We're down to 4.9%. And already the number of job openings are down more than 2 million from the peak. So we are starting to see a gradual movement towards a weaker and easier labor market out there.
Real quick, I know you cover Asia quite a bit in terms of your analysis. There's a lot of talk that they're now picking up steam coming out of this sort of post-COVID world. How do you see growth over there? And is there a particular country or countries that you think are worth investors to look at?
Well, I think Asia is exciting, but we're not seeing a lot of inflationary pressures. China, for example, the producer price index is actually negative on a year-over-year basis, and the consumer price index is barely positive. So they are in a sweet spot because they didn't put a lot of stimulus out into the overall economy. And by the way, if China is not experiencing inflation, that means they don't have to raise rates. And that means that a lot of the countries that they trade with, whether it's South Korea, whether it's Japan, whether it's Malaysia, all those countries, they benefit from the fact that China does not have to pursue a contractionary monetary policy.
Yeah.